Hello and welcome. It is Financial Modeling World Cup weekend, and so I'm going to take a break from the golden age of Excel esports and do something that looks more like real work as a little bit of practice. So we've been told that the main question for this round is going to be about leveraged buyout with management rollover, and there was a case on a similar topic before, this one called Roca Rola Rollover by Janis Beikmanis back in 2021. So I'm going to have a go at that today. So I've read through the case description, so I'm going to try and just work from the Excel file, but basic idea. We're buying a company called Roca Rola. We're buying it at the end of 2020. We're exiting at the end of 2026. It's currently a publicly traded company. We're going to pay a premium of 30%. This is the number of shares outstanding. This is what the founder owns, and the founder is going to roll over their equity into the new co. We're going to exit at a 7x EBITDA multiple. This is the percent of the purchase excluding. So we're going to exclude the founder's share because we're not giving them cash; they're rolling over, and we're going to exclude excess cash in the company, and we're going to exclude the fees which are fully paid by the sponsor, and the rest is funded 80% by debt and 20% by equity. And then we may or may not, in the base case we don't, have to refinance the existing debt. So then we've got some revenue and balance sheet information for 2020. Then the debt is going to be a mix of 4 different types. You've got term loan, subordinated loan, PIK loan. We've got interest for each of those, and the percent of the total debt, the interest for the existing debt. One little quirk is that the existing debt interest is based on the average balance over the year. For all the others, the payments are made at the end of the year, so it's just the interest is on the opening balance. Then we've got various fees on the transactions. The M&A fee is 1% of the purchase price. Debt financing fee 5%. Early repayment fee, if we refinance the existing debt, is 1%, and other transaction-related costs are 1.2 million. LIBOR, it's an interesting reflection of the times, I guess, that the LIBOR forecast was just a fixed number. I don't think you'd find that in a lot of models today, but different times. And this is just, I guess, saying that plus 350 means 350 over 10,000, i.e. 350 basis points. Tax is 20%. There's a minimum cash balance of 250. So I mentioned the excess cash. Right now there's 426. We need to keep 250. So some of the excess cash will be taken out right away. If there's any cash above 250 million later, then we use it to pay off term loan A until that's paid off, and then to pay off term loan B. Then we've got growth rate projections for revenue, for EBITDA margin, and for SG&A as a percent of revenue. CapEx, and we're told that CapEx is set equal to depreciation, so PP&E stays the same. Inventory days stable over the projected period. And then an amortization schedule for each of the debts, and for the existing debt if it's not refinanced. Okay, so enough chat. Let me bring in my, actually no, I'm not going to start with my timeline yet, because I think a good place to start here is with simple sources and uses. So let's do sources. Easier to start with uses, I think. So we'll start with the purchase price. And for that, we're going to need these 3 things. Let's widen those out, I guess. And gosh, can I remember? I think I used Control-Shift-P as my shortcut, but my handy dandy robot command that pastes a link but also marks which assumptions have been used. I love it. Anyway, so then the purchase price, is price per share times 1 plus the premium times the number of shares outstanding. Then what else? Uses, debt refinance is going to be the outstanding debt balance here times this. This is formatted, which I don't really love, as a yes or a no, but it's actually a 1 or a 0. So if we refinance, that's a 1. If we don't, it's a 0. So we can just multiply the debt by that. And let's just copy this format down a bunch. There we go. Purchase price debt, and then the other use is fees. So we've got 4 different kinds of fees, and I'll paste those in there. So the other transaction-related fees is just that. Early debt repayment fee is going to be 1% times the amount of debt refinanced. The debt financing fees we'll have to come back to because we have to size the debt later, and the M&A advisory fee is the purchase price times 0.1%. Okay, and then total fees is all of that. So then total uses is this plus this plus this. Okay, and then sources. So we've got the founder equity, for which we need this. So the founder equity is the price per share times 1 plus the premium times their number of shares. Then we've got the excess cash, which is the opening cash minus the minimum cash balance. Then we've got a sponsor equity injection for the fees. That's TBD because this is TBD. And then after the sponsors pay the fees, we take off the excess cash, and we take off the founder equity. The rest is to be financed by an 80-20 split. So I'm just going to say to finance. And that is going to be the purchase price plus the debt refi, but not the fees, because I don't want to create a circularity, minus the founder equity minus the excess cash. Okay, then debt. So our mix of debt is this, and our types of debt are this. Then, sorry, and our overall percent of debt is here. Just paste that there, I guess. So it's going to be this times these, and then total debt. Okay, and then sponsor equity main is going to be the other 20%, which is that minus that. So then total sources. And so now that we have the total debt amount, we can calculate the debt financing fees, which is this times this. And then we can add up our total sources, which is, oh, sorry, then we've got to also link that in there. So then our total sources are founder equity plus the excess cash plus sponsor injection for fees plus the main sponsor injection plus the debt. And quick check, but that does look the same. Yes, so I'll say that equals that. And then I also want the equity split after. Actually, no, let's do before and after. So I want the founder, sponsor. So before, after, and sorry, I guess it should be founder and others because it's not the sponsor before. So before, it's that over the 9.8 outstanding, which is 15%, and others is 1 minus that. And then after, oops, is the founder equity divided by founder equity plus sponsor equity plus other sponsor equity, which is 49%. And again, sponsor share is 1 minus that. Okay, so now I think we're ready to start making projections. So now I will import my timeline. And we're looking for the start date of here. No, we're really not. We're looking for a start date of that plus 1. So let's just do. And then we're looking for 6 years, and we're looking for 12 months per period. So it's only an annual model. Hide all the rest. We're going to hide this. And just going to kill one column so I can actually see the whole thing. And then let's get started. All right, so we want to make our income statement. So we've got our revenue. So let's just do it like this. So that's what it was for 2020, and then we've got growth rate assumptions here. I guess let's do rev growth. So then it's this times 1 plus this. Okay, so that's our revenue. Then we need COGS. We need SG&A, and then we need EBITDA. So yeah, we have an EBITDA margin. Oops. So that's going to be this times this. Where's my formatting all over the place? Never mind. Then SG&A as percent of revenue is going to be there. SG&A percent. So again, it's just going to be this times this. And then the COGS is going to be the balancing number. So it's going to be the revenue minus SG&A minus EBITDA. Okay. So then we're going to be interested in interest. Net for tax, and profit after tax. Then what else do we need? Well, cash flow. Statement. Which I guess let's start from NPAT and make our adjustments. And then I'll come back to that. And then, so to move on to interest, we're going to need debt schedules times 5. So we've got our existing debt. Actually, wait, I've just got a debt schedule option here. Let's add template debt. Sculpting, so we're going to add template debt. Okay, I seem to only have weird ones, but whatever. Fine, mortgage will do for now. Font size is weird, but never mind. The rest is 20. Okay. All right, so the origination fee I don't need. The draw is going to be that. The repayment can set off. Yeah, you know what, this is not working because this is offset by 1. I don't know what's going on. Anyway, fine, I'll just take the setup and go from there. So the draw here is going to be, there is no draw, it's just the closing, which is, sorry. I just noticed I didn't use those. I guess they're not relevant. But fine, we'll mark them as used as they're going to get. That one is as used as it's going to get. So debt balance goes there. Then the opening is that. There is no draw. I'm sorry, it's going to be that times 1 minus this guy. Then the repayments. Give me this. Only out as far as 26. But it's going to be, let's just make it 350 and copy across, but then it's going to be max of that and minus this. And then that's going to send those. Earth. Anyway, it's not 3360, but I don't know why it's erroring out. Is there no 3360 here? There is. I'm confused why that's erroring out, but anyway, I don't have time to screw around with that. So, sorry, the interest here is, and again, I should link. So let's do that. And then it is average of this and this times this. Okay. And this is not a mortgage, this is existing. All right. That was a big horrible mess. Oh yeah, that's right. I want to split my scheduled versus other payments, because I do have other payments for term loan A and term loan B. So let's do TLA, get rid of all that. Then this can be from the sources and uses. TLA, can be that. Then the scheduled will be based on this. Sorry, only got to 26. Repayment schedule. So it's going to be minus. Right, sorry, so scheduled, and there's also early. And I do remember wondering, I think this was not totally clear in the instructions, but I've confirmed it since, that if we make an early repayment of, say, minus 100 here, that we would still pay 14% of the original balance, not adjusted for that. So this is going to be equals minus the min of this and this times this. Happy days, and then early payments we'll come back to later. Okay, so that's TLA. Let's go TLB. Right. So closing, link to here. The interest, we'll go get it. Oh, hang on, sorry, I haven't updated either of these. That's not good. So L plus 350 is this just, yeah, it's just formatted as a number, so it's just going to be this lock plus this over this lock. I don't know what that formatting is about, but fine. So then this goes into term loan A, and this goes into term loan B. Oh, sorry, they're both still labeled term loan A, but never mind. This one is in fact term loan B, and the label should be updated. Okay, so we have different amounts. We have not updated the payment schedule. Let's do that now. So that one's pretty backweighted. Okay, so that's term loan A, term loan B. Then we've got our subordinated loan. Balance of that is going to start off here. The interest is going to be 8%. Subordinated loans are more expensive. There are no early payments for this. Oh, sorry, I just realized I'm doing average for all of these, but that is not what you're supposed to do, because that will create circularity with the early repayments. You're supposed to do it just on opening and assume that repayments happen at the end of the year. So let's fix that here and here. And then here, there's a row missing, so I don't want to copy the same formula, but okie doke. And then this payment schedule, no, I have not brought that in yet, so let's do it. Okay, happy days. And then finally the PIK. Now the PIK is a payment in kind loan, which means that the debt is going to be added to the balance. So we'll just take this, put it up here. And then let's get everything in. So we need the interest, which is here. Sorry, this says sub, but I mean PIK. The initial balance is here. The schedule of payments. So it's 0, but we'll link it up anyway, just to be good financial modelers. And that is getting amortized. Yes, good. And actually, this one should not be off the existing balance. It should be off. Well, it doesn't matter because it's not getting paid off, so I'm not going to bother. So totals. So I want the total scheduled. I want the total early. I want the total interest. And I want cash interest. Oh, and I want the closing balances, obviously. So we'll say some ifs of this, where this lock is this. Oops. Annoying. So put that there, and then drag it down. Oh, right, cash interest I'll have to do differently. So let's get that out of there, and cash interest. Actually, no, I'm just interested in the non-cash part coming out as the adjustment, so that's fine. So here I'll need to adjust for working capital, I'll need to adjust for D&A, for CapEx, and then non-cash interest. But for now, the cash interest, which is row 91, is what I need for, sorry, not the cash interest, the interest expense is what I need here. I'll put a minus sign on it, copy it across. That's concerning that it's 0 ever after. Probably didn't lock something right. Yes, I did not. Okay, try again, there we go. So then it's going to be this plus this. Then the tax, we have a tax rate, just a flat rate, I think. Yes. These are used. Then tax. So it's going to be minus this times this. And then it's going to be this plus this. Okie dokie. So then our net profit after tax is here. Then our working capital will need to work out. So we've got inventory, accounts receivable, accounts payable. Initial balances of these. And we've got days here. Okay, so the inventory is going to be, actually, let's do days in year, which I think I have as a variable there. Yes, happy days. So we got 1,366. So it's going to be, inventory is going to be COGS. I guess we'll do it one at a time. COGS divided by days in the year, multiplied by this. And then accounts receivable, I think it did say inventory. Use only the sales or closing sales or COGS balances, fine. So then the accounts receivable is going to be the same formula. It doesn't look right. Oh yeah, because you didn't lock that, whoops. It still looks like a big jump from here to here. That makes me a little nervous. Yeah, sorry, that's because that's your payables. That should be that formula. The receivables should be on sales. Yeah, not that, but the line above, please. Okay, so now they all look relatively continuous. That seems okay. So net working capital, change in net working capital. I always have to stop and think about this. The net working capital is, so inventory and receivables are both locked up. Payables are good. So then it's going to be this minus this. So you're basically locking up a little more capital over time as you're growing, which kind of makes sense. Fine. So change in working capital. Maybe the opposite sign of this. Adding back depreciation amortization, that is here. So we're adding them back, adding back our non-cash interest, which is the PIK loan here. So then that's going to be our CF from operations. Oh, hang on, wait. Sorry, we also need, oh no, sorry, the early repayments are going to be financing activities, that's fine. So CapEx is going to be our only cash flow from investing, and then cash flow from financing is going to be scheduled and early, which will get us to total cash flow, and then we'll have opening, closing. Okay, so cash from operations should just be the sum of these. CapEx is going to be just the opposite of this because it's to keep them the same all the way through. Then scheduled repayments are going to be from here. So then, I guess what I want is, I'll make it a separate working section down here, I suppose. CF before early payments. And that is going to be cash flow from operations plus cash flow from investing plus scheduled repayments. And then we're going to say minus the min of this plus this and this. Circularity. Really? Is it? Alright, well, sometimes it's easier to just turn on circular refs. I'm confident that there's not a true circularity, so I think it'll just immediately converge. So that's that. Then my early repayments, sorry, here now kick in, yes. We'll carry that across, and that seems to be paying off too fast, because I do remember looking at this question before, and it didn't pay off that fast, but never mind. Right, so let's just go with early repayments, and I'll look at questions in a minute, and that'll help me calibrate, but here. So it's financing, investing, and the operations. Boom. Yeah, that's too good. That's not correct, but never mind. So that's that, and then I also need to do early repayments on term loan B, which is going to be a similar formula, but it's going to be equals minus the min of this plus this, and this plus what's already been given to term loan A, which means nothing gets paid off until term loan A is paid off, and then that gets paid off, and then we're happy. Except that it's going too fast and I've done something wrong, but never mind. So then our opening cash was just the minimum balance, because all the excess was swept away. So that's our closing. So it's going to be previous closing plus total cash flow. Sorry, opening is that, and then this plus that. Okie dokie. So now let's answer questions, and I'll see where I went wrong, because I'm pretty sure I remember this not being that good. But okay, EBITDA amount in 2024. Let's just, I guess, add a question section. How many questions are there? 18. Okay. So EBITDA in 2024. $660.48. Yes. Okay, EBIT in 2023. Oh, right, yes. Because I don't have depreciation amortization in here. So D&A. And I guess that does mean I need to introduce another line for EBIT, because it wants to know about that. So D&A is going to be, wherever it is, yeah, that minus sign. Silly mistakes. Anyway, oops, all right, I got can't do that, so let's just do equals this plus this, and then this can point to there. That seems altogether more sensible. Okay, what year do we want EBIT from? 2023. So 457.3, yes, that's A. All right, change in net working capital in 2025. 441, sorry, no, not the working capital, the change in working capital, which is row 127. So 27 point, I think these are all meant to have one less decimal place. Let's do that. 27.7, it's an increase, that's F, good. Okay, in the base case, total funds required to buy the shares in Roca Rola should be calculated before fees, after founder rollover, and after using the excess cash, which is what the total debt is sized of. Yes, so that is the to finance amount, 1915.5B. I will say there was a bit of a bear trap here, which is unusual for them, although it did mention to say use excess cash in the question, but if you forgot to use the excess cash, so if we just add back the excess cash, you get 2092.2, which was also one of the answer choices, which they don't usually do that kind of trap, but anyway, just so you know. In the base case, what is the amount of debt that will be raised to fund the transaction? That 1532.4, which is B again. Question 6, in the base case, what is the amount of equity they spent funding the transaction, including the fees? So that is, sorry, not sponsor equity fees plus sponsor equity main. Probably the way I laid that out, I'm at high risk of only picking up this part and making a mistake, but never mind. 394, yes, that's C. Question 7, in the base case, how many percentage points did they increase their share in the company by? A surprisingly large number. 33.6, which is yes, F. Okay, question 8. In the base case, what is the PIK loan interest expense in 2022? PIK interest 2022. 20.6, yes, that's D. Question 9. In the base case, what is the early repayment amount for term loan A in 2025? Early repayment term loan A in 2025. This is, by the way, another sneaky one I remember, because the scheduled repayment amount, the 87.6, was also among the answer choices. So if you just looked at your term loan A and said, oh yeah, 87.6, I see that among the answer choices, you would have got that wrong. Again, I don't think they're usually sneaky like that anymore, but it was the Wild West in those days. Okay, in the base case, what is the operating cash flow in 2023? I'll be honest, I only modeled this as cash flow broken out into, operating and investing and financing, because I remembered that was one of the questions. Because normally I don't. I just do a big blob of adjustments and then say that's it. Anyway, sorry, what year did we want? Here, operating cash flow 2023, which is here. So 426.0, yes, that's E. Okay, 11, in the base case, what is the amount the BSV investing will receive at the exit date? All right, so let's do the exit stuff. So we have an EBITDA multiple, right? Oops. Yes, EBITDA. Okay, so we want EBITDA. Gosh, these models get big. Okay, so EV is going to be that times, let's grab our multiple. Okay, then we want to subtract our net debt, but only, and it does mention this in the write-up, somewhere, financing, valuation and exit strategy. Yes, to arrive at the equity value at the exit, remember to add excess cash only, the amount available to Roca Rola over the 250 million min cash requirement. So normally you would subtract off net debt to get from an enterprise value to an equity value, but here we're saying you can't take the 250 million because they need that, and I think that's all the cash they have left. it is. But anyway, let's just figure it out. So net debt x min cash, that's going to be closing balance of all the debts minus the closing cash, yes, plus the minimum closing cash, which I'll just link back to here. Okay, so then equity value going to be this minus this, which isn't looking familiar, I must say, but never mind. Then founder share, sponsor share, and their splits are from here. Yep. So it's going to be this times this. Okay, and finally, what was the question? The amount they will receive at the exit date. Oh, okay, well, I guess we're good. 2194, that is one of the answers. 294.0, which is A. Okay, question 12. In the base case, what is the sum of the free cash flow to equity? Oh, God. I always have to stop and think, what is free cash flow to equity? I think the answer is that it's just the same as cash flow here because there are no dividends paid out. I also think because the cash didn't go up, it's 0. So hang on. NPAT, working capital, D&A, non-cash interest, those would all be part of it. The investing, yes, that's not available to equity. Debt repayments are not, yeah, so I think it's just the net cash flow in this case, and the total cash flow is 0. Although I would have been nervous selecting that answer, I do think it's the right answer. So just say sum of, don't know what is going on with my Zoom, and that is answer A. Okay, in the base case, what is the IRR and cash on cash multiple? Use XIRR for calculation. Okay, so whoops. So I'll just make that sponsor cash flow, and here they pay in. Really should have just combined these two into one place, but never mind. So IRR, cash on cash. So the cash on cash is just minus the exit divided by ingoing, and the IRR is going to be XIRR of these values and these dates. So we got 33.1% and 5.6. Yes, good. Yeah. That's question 13, and it's answer C. Don't care about linking. All right. So questions 14 to 17 refer to the scenario where the existing debt is refinanced. Okay. So refinance. We want to know the new equity amount that they will. Okay. Really should have just total sponsor equity. I realize it's not the most efficient thing to do now, but it is bugging me that it's set up so badly. So there we go. So the answer is 603.2. Yes, answer D. Happy days. Okay, 15. What is the new equity percentage they own after the acquisition? And the answer is this. 61, that's right, in decimals, oops. 61.5, yes, which is D. 16, new IRR they will earn on the transaction. 28.7, yes. Which is F. 17, assume the bank has determined covenants that the company should follow. Okay, please. Covenants. So we got, are the covenants here somewhere? No, they're not. Why are the covenants not listed in the assumptions? Never mind. Irritating. So we've got net debt, EBITDA, EBIT, interest, debt service coverage ratio. Okay. Seriously, what's going on with my Zoom? It's super annoying. All right, sorry. Net debt over EBITDA. I'm just going to see if there's anything in the write-up about the covenants. There is not. Okay, well then that's no help to me. Net debt. I'm assuming that we should give the benefit of the cash here. So sorry, debt schedules. So here's my closing debt minus my closing cash. And so it's net debt over what again? Over EBITDA. Okay. And the question is, does that ever go over 4? And the answer is no. Just double check this is still is in the, yes, it's still in the refi scenario, fine. Okay, EBIT over interest has to be greater than 2.5, so EBIT presumably over interest expense, not over cash interest. Oh boy, greater than 2.5, so yes, that is breached. This equals or this is greater than 4, that is greater than 2.5, and what's the last one? 1.5. Debt service coverage ratio is EBITDA minus capex over interest expense plus mandatory principal repayment. Okay, EBITDA minus capex. Actually, I have a positive symbol on the capex, so plus capex over, tell me again, interest expense plus mandatory principal repayment. Okay, so my scheduled payment here. And my interest expense is also there, so plus that. Okay, so we got no, yes, yes, which is F. Okay, and for question 18, I can't see this behind my face. Question 18, restore the base case scenario with an assumption that existing debt is not refinanced. What should the EBITDA exit multiple be so they earn 40% IRR? Okay. So I just need to be very hacky about it and just cut this and bring it over here. Just paste it there, that's absolutely fine. And then we're gonna goal seek this bad boy, but wait, sorry. First we gotta go back to not refinancing debt. And now you gotta be careful with this. A little word of warning. So we're gonna set this to 0.4, which is 40% by changing this cell. Oh, crap. This is not good. My circularity is hurting me. Okay, well that's a cautionary note for me. I guess I'll rewrite my SUMIFs, but SUMIFs doesn't normally produce a circularity if it's filtering out the thing that's causing the problem. This is not working at all. Wow, this is terrible. All right, I'm going to say stop. Just do a hand goal seek. Make these 20 point. See what's going on. All right. So the word of warning I was going to say is when I did this before, I said goal seek this to 40%, and it got it to 40% to one decimal place, and gave me an answer for this. But it wanted. Oh, I've actually closed the file, which I should not have. Because it wanted it to 3 decimal places. But anyway, so let's just say, all right, we need to be higher, so go to 8. We need to be higher than that, so go to 9. 9.5, that's too much. 9.2, getting close. 9.1, getting very close. But now at this point we need to, well, anyway, let's flesh this out. So 9.05. And that gets you as close as that, we'll see, but not quite close enough, so we need to go a little higher. 9.51. 9.52, 9.53, 9.54, and this is where you need to get really precise because 9.55 gets you right on, 9.56 gets you over, so 9.55 is as close as you can get to 3 decimal places. So that's a cautionary tale to me. I thought I could just turn on my circs to avoid that wobble with no issues because there wasn't a true circularity, but I guess even a pretend circularity is enough to make goal-seek not behave properly. So, whoops. Anyway, that's all I got for today. Thanks for watching. See you next time. Okay, just a quick add-on to say that I was a bit of a clown here when I was calculating the covenants. So I calculated all the ratios correctly, but I just immediately said, if anything is over, like I looked at the first one, net debt over EBITDA, okay, you don't want that to go over 4. And so I just copied down greater than to the rest. But of course, when you're looking at EBIT over interest, you're not worried about that going too high, you're worried about that going too low, so this should have been less than. And when you're looking at debt service coverage ratio, again, you're not worried about that being too high, you're worried about that being too low. So got all the numbers were correct, but the interpretation was totally wrong because the sign is important depending on what kind of covenant you're talking about. So yeah, don't be dumb like me. Okay, that really is all I've got for today. Thanks for watching. See you next time. Okay, I've made a liar of myself. I'm back for a second add-on, and that is because I later figured out what was going on with the circularity. So I kind of suspected it was to do with this, because the range I'm referring to here includes the early repayments, but summarizing the scheduled repayment feeds into calculating the early repayments and so on. But I thought that sum ifs wouldn't cause a problem for that because I've used this before like this, that sum ifs, when you're referring to a range, if where are my words? If basically it won't create a circularity unless the bits that it's actually using are part of the dependency chain. But I tried just rewriting as just a straight sum for this and for this and for this, and sure enough, that did make the circularity go away. And then eventually I clicked. The problem was because of this array setup, because that meant that the sum ifs that was calculating the scheduled amount was also calculating the total of the early amount. So actually all I needed to do, rather than doing this terrible manual thing, if I just make each one of these calculate separately, then this one is depended on by the calculation of that figures out the early repayment, but this one is not, and so that breaks the circularity. So if I just fill that across, there's no more circularity. So that's just one for me to watch out for, because I'm used to the idea that sum ifs can reference a range that would create a circularity but won't create a circularity if the thing you're pointing at is okay. But by taking a sort of shortcut and referring to the whole range, that actually did create a circularity. So that's a nuance to watch out for. For the third and hopefully final time, that's all I got for today. Thanks for watching. See you next time.